Stop-loss orders are essential risk management tools used by traders to limit potential losses on a position. A stop-loss is an order placed with a broker to sell a security when it reaches a certain price. When you enter a trade, you set a stop-loss below your entry price to limit potential losses. Stop-loss orders work by automatically triggering a sell order when the price reaches your predetermined level. If the price moves against your position and reaches your stop-loss level, an order is automatically triggered to sell the position. The primary benefits of stop-loss orders include protecting your investment capital, removing emotional decision-making, and defining your risk before entering a trade. Stop-loss orders serve as an automatic safety net when markets move unfavorably, making them a crucial disciplinary component of any trading strategy. Standard stop-loss is the most common type of stop-loss order used by traders. Let's see how a standard stop-loss works using this stock price chart. There are two common ways to set a standard stop-loss order. Method 1 is to set the stop-loss at a fixed percentage below your purchase price, typically 5 to 10%. Method 2 is to set the stop-loss just below a key technical support level on the chart. Let's look at an example of a percentage-based stop-loss. Here we purchase the stock at $48 on day 3. We set our stop-loss at 10% below the purchase price, which is $43.20. As the price continues to fall, it eventually crosses our stop-loss level on day 7. At this point, the stop-loss is triggered, automatically executing a sell order to limit our losses. Let's compare the outcomes with and without the stop-loss. Without a stop-loss, you would have suffered a loss of $13 per share, or 27.1%. But with the stop-loss in place, your loss was limited to just $4.80 per share, or 10%. Standard stop-losses offer several key benefits to traders. They execute automatically when price thresholds are reached, removing emotional decision-making. They provide predefined risk control for each trade. They protect against sudden market crashes or unexpected bad news. And they give you peace of mind when you can't actively monitor the market. Standard stop losses are the foundation of effective risk management, protecting your trading capital from significant losses. When setting your stop loss, consider your risk tolerance and the stock's volatility to find the right balance. A trailing stop loss automatically adjusts as the price moves in your favor, maintaining a set distance or percentage from the current market price. Let's first look at a traditional fixed stop loss for comparison. It remains at the same price level, regardless of market movement. Now let's add a trailing stop loss, which starts at the same level as our fixed stop. As the price begins to move up, notice how the trailing stop follows at a fixed distance below the price. The trailing stop continues to adjust upward as the price rises, locking in more potential profit. At the peak price, our trailing stop has moved up significantly compared to the fixed stop. When the price starts to fall, the trailing stop remains in place. It never moves down. As the price continues to fall, it eventually hits our trailing stop, triggering the exit at a much better price than the fixed stop would have given. This highlighted area shows the additional profit preserved by using a trailing stop instead of a fixed stop. Your exit price is much higher, locking in more of your gains. There are two main ways to set trailing stops, by percentage or by a fixed amount. Percentage-based trailing stops maintain a relative distance from the price. For example, always staying 10% below the highest price reached. Fixed amount trailing stops maintain an absolute distance, such as $2 below the highest price, regardless of the price level. Trailing stops offer several key benefits for traders. They automatically lock in profits as the price rises while still providing downside protection. They also help eliminate emotional decision-making, allow trends to develop fully, and remove the need to manually adjust your stop orders. For best results with trailing stops, use them in trending markets. Set the distance based on the asset's volatility, and use wider trailing stops for longer time frames. Guaranteed stop-loss orders provide absolute certainty about your maximum possible loss. Unlike standard stop-losses, a guaranteed stop ensures execution at exactly the price you specify, regardless of market volatility or price gaps. With standard stop-losses, market gaps can lead to execution at prices much worse than expected. Guaranteed stops eliminate this slippage risk. This protection comes at a cost. Brokers charge a premium for guaranteed stops, typically ranging from 0.1 to 0.5% of your position value. The premium is usually only charged if the stop is triggered. Think of it as insurance against slippage during volatile market conditions. Guaranteed stops are most valuable during specific high-risk market scenarios. During earnings announcements, companies can report surprising results that cause large price gaps. Guaranteed stops provide protection against these unpredictable moves. Economic data releases like GDP reports, inflation numbers, or Federal Reserve announcements can create extreme volatility. Guaranteed stops secure your exit price during these events. When holding positions overnight, news or events can cause significant gaps at market open. Guaranteed stops ensure you're protected from these overnight risks. The key benefits of guaranteed stop losses include absolute certainty of your maximum loss, elimination of slippage during extreme volatility, and peace of mind during higher risk trading periods. Time-based stop loss is a risk management tool that exits a position after a predetermined time period if the expected price movement hasn't materialized. Let's look at an example. Here, we enter a trade expecting the price to rise to our target. However, after a significant period, the price action is minimal and our target hasn't been reached. With a time-based stop loss, we exit the position at a predetermined time regardless of price. This prevents capital from being tied up in underperforming trades. Time-based stops are primarily about managing opportunity cost. Instead of keeping capital tied up in trades that aren't performing as expected, you free it up for better opportunities. Different trading styles require different timeframes for stop losses. Here's a guide to appropriate timeframes based on your trading strategy and market conditions. Here are some practical tips for implementing time-based stop losses effectively in your trading strategy. The volatility stop loss dynamically adjusts based on actual market conditions. Unlike fixed stops, volatility stops expand during turbulent markets and contract during calm periods. The most common indicator used for volatility stops is the average true range, or ATR. During high volatility periods, ATR values increase, automatically widening the distance of the stop loss. Conversely, during calm markets, ATR decreases, bringing the stop loss closer to the price for tighter protection. Traders typically use ATR multipliers based on their risk tolerance. Volatility stops have key advantages over fixed percentage stops. The benefits of volatility-based stops make them popular among professional traders. Here's a practical example of setting a volatility stop using ATR. Mental stop losses exist only in the trader's mind rather than as actual orders in the market. Unlike standard stop-loss orders, mental stops require the trader to manually exit positions when their predetermined price level is reached. Mental stop losses offer several advantages, including protection from stop hunting and more flexibility during volatile markets. However, they require strong discipline and leave traders vulnerable to emotional decisions, which can result in larger losses if not executed promptly. Mental stop losses are most appropriate in specific scenarios, particularly for experienced traders who can continuously monitor the market. They should be avoided by newer traders during major news events or when you cannot actively monitor your positions. When implementing a mental stop loss, first determine your exit price before entering the trade. Then commit to exiting manually if that level is reached. To maintain discipline with mental stops, write down your stop level before trading, use price alerts, and consider practicing with smaller positions. When used correctly, mental stop losses can be effective, but they're best combined with other risk management techniques to protect your trading capital. Chart pattern stop losses are placed based on technical analysis patterns and key support and resistance levels. These stop losses provide technically sound exit points based on pattern breakdowns rather than arbitrary price levels. They're aligned with market structure, minimize premature exits, and provide clear invalidation points. The head and shoulders pattern is a key reversal pattern. Place your stop loss just below the neckline with a small buffer of about 0.3% to avoid false breakdowns. Double top and bottom patterns signal potential reversals. For double tops, place your stop loss slightly above the second peak. For double bottoms, place it just below the second trough. Support and resistance levels offer logical stop loss placement. For long positions, place stops just below key support levels. For short positions, place them just above key resistance. Trend lines help identify the primary market direction. Set your stops just outside the trend line with a small buffer to account for market noise. Exit when price action invalidates the established trend. Moving averages provide dynamic support and resistance levels for stop placement. Use the 20, 50, or 200 period moving averages, depending on your time frame. For long trades, place stops just below these key moving averages. When using chart pattern stop losses, analyze multiple time frames for confirmation, add a small buffer to avoid market noise, combine different methods for reliability, adjust your position size based on stop distance, and always wait for pattern completion before entering a trade. Percentage-based stop losses are set at a fixed percentage below the entry price. For example, if you buy a stock at $100 with a 5% stop loss, your stop would be set at $95. This means if the stock price falls to $95, your position would automatically be sold to limit your loss to 5%. Different asset classes require different stop-loss percentages due to their inherent volatility. Large-cap stocks typically use tighter stops of 2 to 5% due to their lower volatility, while cryptocurrencies may require wider stops of 10 to 20% to accommodate their high volatility. Percentage-based stops are essential for calculating position size, which helps manage overall account risk. To integrate percentage stops with your risk management strategy, balance your total portfolio risk with appropriate stop percentages. The key insight is finding the balance between protection and giving your trades enough room to breathe through normal market fluctuations. In this final section, we'll explore how to implement effective stop-loss strategies to protect your trading capital. When selecting a stop-loss strategy, consider both market conditions and your trading style. For trending markets, trailing stops work well, while volatile markets benefit from volatility-based stops. Your trading style also affects your stop-loss choice. Day traders often use time-based stops, while swing traders might prefer chart pattern stops to avoid premature exits. Let's examine common stop-loss mistakes traders make. Setting stops too tight often results in premature exits due to normal market noise. Instead, use average true range to set appropriate minimum distances. Conversely, setting stops too loose leads to excessive losses before your exit is triggered. Your stop loss should always align with your personal risk tolerance. Many traders use the same stop approach in all market conditions, which is suboptimal. Instead, adapt your stop strategy to the current market environment. Perhaps most damaging is moving stops based on emotions rather than analysis. Set your rules in advance and follow them strictly to maintain discipline. Backtesting is crucial for validating your stop-loss strategy. Start by selecting historical data that includes various market conditions, then apply your entry strategy with different stop methods. Track key metrics for each stop-loss type and compare the results to refine your approach. This empirical testing is far more reliable than theoretical assumptions. Important metrics to track include your win-loss ratio, average win versus average loss, maximum drawdown, profit factor, and how frequently you're stopped out prematurely. For comprehensive risk management, consider combining multiple stop-loss types. Start with a percentage-based initial stop to set your base risk according to your account parameters. Once your trade moves in your favor, implement a trailing stop component based on the average true range to lock in profits while giving the trade room to breathe. Finally, add a time component to exit the trade if price action stalls or your expected move timeframe passes. This helps avoid opportunity cost when capital could be better deployed elsewhere. To summarize the key points about implementing effective stop-loss strategies, match your stop-loss type to both market conditions and your trading style. Avoid common mistakes through proper position sizing and predefined rules. This maintains discipline even during emotional market conditions. Always backtest thoroughly before implementing any strategy in live trading to validate its effectiveness across different market environments. Consider hybrid approaches that combine multiple stop types for more comprehensive protection against various market risks. Finally, regularly review and adapt your strategy as markets evolve. What works today may need adjustment tomorrow. Remember, effective stop-loss implementation isn't just about avoiding losses. It's the foundation of successful trading and sustainable profitability.